Welcome to the second day of our annual Model Portfolio Review Week. We're just gonna let maybe another couple seconds, just let everybody get settled. But Charles and I are tuning in from the Chicagoland area. You can use the question section of your GoToWebinar control panel, and you can let us know where you're tuning in from. We always like to hear. And I asked this yesterday, if you joined us for our model shadow stock portfolio, I always like to ask our audience if we have any dividend investing portfolio holders here. And if so, we'd love to hear how many stocks in the portfolio you're currently holding. You can feel free to share that via the chat, kind of get used to it. And again, we're just really happy to have you here. Thank you so much for taking the time out of your busy schedule this afternoon. We're really excited to share some good stuff about the dividend investing portfolio. All right, looks like everyone's pretty much settled, so we'll get started. We have a lot to cover, so I want to get through the intro and a little bit of information to share with everyone. So hello and welcome to this afternoon's webinar, AAII's Dividend Investing 2025 Portfolio Review, led by Charles Rotblut. Thank you so much for joining us. We're happy to have you all here. So my name is Jennifer Shear, and I will be your host for today. We really appreciate you joining us for the second day of our Model Portfolio Review Week. We do this annually, and in this presentation, we'll be taking a look at the dividend investing model portfolio. And then each day this week, we're highlighting a different AAII model portfolio. So tomorrow at 1 p.m. Central is John and Cynthia will walk us through the AAII growth investing model portfolio. And if you are interested and still want to register, there's plenty of time. So you just visit AAII.com/webinars to register. And before we begin, there are a few things I like to go over. So I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. If you want to view or read our full disclaimer, you can visit AAII.com/privacy/disclaimer. And then please keep an eye on your chat section throughout the webinar, as I'll be sharing helpful resources and links that pertain to the content of today's event. And then if you have any questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, I'll select a few for Charles to answer. If your question isn't selected during the broadcast, please feel free to email us at members@AAII.com. Presentation slides are available under the handout section of your GoToWebinar control panel. It's located on the right-hand side of your screen. We will also email this to all attendees. If you happen to experience any issues with the audio or the video of the webinar, sometimes it happens, feel free to visit the GoToWebinar websites for support at gotowebinar.com. I'll put some helpful links in the chat as well, just in case you need to adjust those settings. This presentation is recorded, and a replay of the webinar will be available on our YouTube channel as well as AAII.com/webinars. And for new viewers, we always like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And in this presentation, Charles will cover a few things such as how to identify companies poised for strong dividend growth in 2026 and beyond, what qualifies as a higher yielding stock in today's environment, about the new candidates now appearing on the DI ideas list, how to use the dividend grader and the dividend screener, both really powerful tools to find and evaluate your own dividend growth stocks. And then we have a special offer for today's attendees. You can get a $50 discount on any new one-year subscription to an AAII premium product, including AAII Platinum, which is our bundled service, by visiting AAII.com/webinar-week and entering the promo code webinarweek50 at checkout. And I know that's a lot of information to digest. I threw a lot at you, so please don't worry. I will add it to the chat momentarily so you can easily copy it and access. And then we'll also include everything in the email that's sent to everyone who attends today. And with that, I'd like to hand over the presentation to Charles.
Thanks, Jenna. Thanks everyone for attending. Glad you're with us today. Today, as Jenna said, I want to talk about dividend stocks. I'm just going to rearrange some things here on my screen real quick so that I can see. Sorry, I'm having to work my screen a little bit backwards here, but that should work. So a brief, suddenly my slide's not wanting to work. Let's try, there we go. Strange, okay. Sorry about that. It was working before the presentation started, but that's how things go. But anyway, here's an overview of what I'm going to talk about today. We announced on our website probably about 40 minutes ago or so that we added a new stock to the portfolio. Those of you who are DI subscribers are going to receive an email about the commentary soon, but I'll talk about it in today's webinar. And also near the end of this presentation, I'm going to talk about a new dividend feature we've added to our rebuilt My Portfolio tracking tool. So I want to start by looking at the market from a dividend investor's perspective. Right here is the S&P 500, and there's really 3 lines on there. The dark black line is the S&P 500, tracked by the iShares ETF. The middle line, kind of the, I don't know, yellowish greenish line, I'm not sure what color to actually call that. That's the Invesco S&P 500 equal weight ETF, and that bottom green line is a ProShares S&P Dividend Aristocrat. So we have the market cap weighted S&P 500, the equal weighted S&P 500, same stocks, different market cap, and then the Dividend Aristocrats, the companies who are members of the S&P 500 who have raised their dividends for at least 25 years. As you can see here, the S&P 500 had the strongest performance, and that's because high beta, meaning volatile momentum and growth stocks, were really the big winners in the S&P 500 last year. We saw value, we saw a low volatility, dividend, low beta type stocks. Those tended to not do as well, which is not surprising because we saw that artificial intelligence had a big influence on the S&P 500 last year. But the other thing that happened is the S&P 500 became very concentrated. It was concentrated beforehand, but now it's really at historical levels, at least levels we've not seen in several decades. This chart's from JP Morgan Asset Management. And what I want to point out here is that the 10 largest stocks in the S&P 500 account for 41% of its market cap. 44% of the S&P 500's return last year is attributable to just NVIDIA, Alphabet, Microsoft, Broadcom. 4 stocks accounted for almost half of the S&P 500's return. And the reason why that's possible is the S&P 500's market cap weighted, and you look at the quote unquote Mag 7 stocks or large technology stocks, they are driving the S&P 500's return. That's why when you look at the performance of the equal weight S&P 500, it's less than the S&P 500 because you had that performance of those mega stocks. NVIDIA alone last year accounted for 15.5% of the large caps index. That's just one stock out of 500 driving the S&P 500's performance. And certainly today, you might make an argument that NVIDIA's the amount of influence it has in the S&P 500 is probably going up today based on NVIDIA's announcements about new chips. Now, let me go the other way here. So the other thing that happened last year is we saw the 10-year Treasury yield decline, but it was a modest decline, even though we saw the Fed cut rates. And one thing to notice, if you look at this chart, 4% yield has been a lot of support on the benchmark 10-year yield. We have not really seen it dip below that level. But what's notable, but that even though yields came down overall, we're still continuing to see longer-term bonds or very short-term bonds and money market accounts providing competition for income-seeking investors. So they do still provide some competition to dividend stocks, although when you buy a bond, and especially when you invest in a money market account, you do not have any chance or very little chance in case of bonds of realizing capital appreciation. They're really income-driven investments, whereas dividend stocks can give you a total return, meaning both capital appreciation and income. And with dividend stocks, because they can raise their dividends, you can actually get an increasing flow of income. So the other thing last year we saw was the stock market's yield fell below 1%. So I'm using here the Dow Jones US Index ETF, and this is a broad ETF designed to really mimic the US market. And it fell below 1% last year. end of last year, as you can see on this chart, it was at 0.97%. The implications of this is that investors should adjust their expectations for what they consider to be a reasonable yield. Because you can see as DI, even though we do seek higher yielding stocks, or at least stocks with yields above the market's yield, the DI's portfolio was 2.42%. So what you consider to be a high yield is now lower than what it might have been previously because the market's yield has been driven down. And there's only so much we can do because the DI portfolio's yield is influenced by the overall market's yield. If the market's yield's going down, so will the yield of the stocks that are attractive and have strong dividend characteristics to them in terms of fundamental strength, in terms of valuation, and in terms of the ability to continue growing the dividend. And that backdrop is exactly why discipline matters when you're looking at dividend stocks. So one thing we are seeing here is overall, when you look at the S&P 500, is in addition to a lower yield, we are seeing slowing growth rates. You can actually see that last year, the median dividend increase for the S&P 500 among S&P 500 stocks shrank to 5.88%. That's at the far right end of the chart. Concerns about tariffs last year and uncertainty about the economy both played a role in companies being more conservative in terms of their dividend increases. We're also seeing companies continue to favor buybacks. A lot of companies like buybacks because not only does it sometimes give a more quick boost to the share price, but it also is not as committal as a dividend growth. So when you grow a dividend, investors expect you to raise the dividend every year. Buybacks, you cannot buy back share during a certain quarter or even 2 quarters or beyond, and you do not get the pushback you get as if you don't raise the dividend. So a lot of companies, when they allocate capital, they do consider buybacks. And we've certainly seen active investors step in, pushing for buybacks to try and get a higher share price. But even still, we do know over the long term, growing dividends do contribute to rising prices as well. So one of the things we did this afternoon is we announced the addition of Merck. Merck's pharmaceutical treatments include biologics and therapies and vaccines. About 10% of their business is to animal health. Now, many of you obviously are familiar with Merck, very big drug company. But what's interesting about Merck is even though it's been big and there's been some questions about some of the big pharma companies' pipeline, Merck describes its current pipeline of new pharmaceutical treatments and phase 3 trials as being the strongest and deepest in recent memory. Those are the words from Merck's executives, not from me. And phase 3 trials are basically the last set of trials that a company needs to go through to get its drug approved. So phase 1 basically tries to see, does the drug actually work? Phase 2 tries to actually test for really how well it works among patients that have it, looking for side effects among people that take it. Phase 3 really goes for a much broader audience, and they're really here looking for side effects and things that are not going as well as they'd expect with the drug. So when you hear those commercials about everything the drug can cause your skin to turn yellow, cause your hair to go spike up, cause you to start dancing uncontrollably, all those warnings tend to come out of the phase 3 trials. But once a drug gets through the phase 3 trials, then it can go to regulators for approval. And so the more drugs a company or pharmaceutical treatments a company has in phase 3 trials, the more likely it is to have new medicines approved by regulators and then hopefully picked up by doctors and hopefully recommended by doctors and obviously have coverage approved by both Medicare and the big insurance companies. Now, in choosing Merck, we considered its grades for each of the 3 dividend pillars. So dividend investing, our strategy is based on 3 cornerstones or pillars of dividend investing. They are dividend valuation, dividend growth, and dividend strength. And we assign them grades of A to F. Now, these grades are just like the ones you got in school. A's will make your parents happy, F's will get you grounded. We look for grades of A or B because we're not seeking perfect stocks. We're seeking attractive stocks trading at attractive valuations. As you can see here, Merck has grades of B for dividend valuation, dividend growth, and dividend strength. All those are good grades. And you can access all the grades for dividend paying stocks on the DI website at di.aaii.com. Now, one of the things we consider when we look at a stock is its relative yield. So, and I'll get to that for a second, but we see here in Merck, its absolute yield is 3.2%, and we look at that as well. And so we obviously want stocks that are trading at higher yields than the broader market. We also do consider buybacks because buybacks still return capital to shareholders. So we look for both, and we want to see the shareholder yield bigger than the dividend yield because the shareholder yield includes the buyback yield, the reduction in share count, plus the dividend yield, which is basically the dividend paid divided by the share price. And again, we consider both because they reflect a company's allocation priorities. Now, the reason why I mentioned relative yield is relative yield compares a stock's current yield to its 5-year historical average. And so we're basically looking to buy stocks trading at attractive valuations. So we want to see stocks whose yield is above what investors have historically paid for the stock over the last 5 years. We've actually borrowed this from Geraldine Weiss. And so when you see a stock's yield being above its 5-year average yield, it means the stock's trading at a bargain. When you see the stock trading below its average yield, then it's starting to get expensive. And certainly when you see a stock's yield fall below its 5-year average high yield, meaning the average high yield for the last 5 years, when it falls below that mark, we consider the stock to be overvalued, and then we move to sell it. So Merck's current yield of 3.2% is above its average 5-year yield of 2.8%. So it's not right if it's 5-year average high. I'm going off memory here. I want to say it's about 3.5%. So it's above its average and not quite as high, but that yield tells us that Merck is trading at an attractive valuation. Now, Merck's dividend growth characteristics. DI is a dividend growth strategy. So although we do look for stocks at attractive valuations, we also want companies that grow their dividends. And Merck has just raised its dividend by 4.9%, literally 7 weeks ago. So really soon after Merck raised its dividend, we added this stock. Another thing about Merck is we do look at characteristics that say the company has the ability to grow its dividend. One of those is return on assets, a measure of how effectively a company is turning its assets into sales. Merck has one of the highest levels of return on assets, ROA, in the healthcare sector, so that's really good. Now, some of you might notice on its cash flow from operations, it's got a D score. Cash flow from operations is basically how much cash is the company generating for normal business operations. It can be subject to timing issues. And what we saw here with Merck is that if you go to the third quarter of last year, the third quarter of 2024, what we saw was a big jump in cash flow operations for that quarter. So it created tough year-over-year comparisons. And that's why we saw the D grade for cash flow operations. So Merck is still producing positive cash flow. It's fundamentally strong. This appears to be more of a timing issue than anything else. Now, the other thing is that Merck possesses 3 growth characteristics we desire. It does have the financial ability to continue raising its dividend. It's also raised its dividend for 16 consecutive years. It's raised its dividend every year since 2010. And it recently verbally committed its commitment to continue raising the dividend. So Merck has not only have a history of raising its dividend, it also still shows the intention to grow the dividend. And also it's a 1 in 5 year dividend growth rates are above that as inflation, which we do want over time. We want to see the dividend growing faster than the rate of inflation, so that because we know over time $1 today is not worth $1 tomorrow. So we want to see the dividend rising stronger. So we're not only are we getting adjusted for inflation, being compensated for inflation, but we're also getting extra growth on top of it. And the other reason we like dividend growth is it does lead to higher returns. So this data is from Ned Davis Associate and Hartford Funds. And what it shows you is that if you go back to 1973 and you put $100 into a portfolio of S&P 500 dividend growers, that would have grown quite substantially. But if you put the same dollar into non-dividend payers, it would have actually fallen considerably. It would have actually cost you money. You would have lost money on that scenario. And the big lesson from this is, if a company cuts its dividend, run, don't walk away, because chances are the stock is going to drop. Usually when companies cut their dividends, if there's not an economic catastrophe or something big happening at the macro level, it usually means there's problems with the company, and those problems will get reflected into the share price. But one thing that's interesting to note, if you look at the column on the far left, compare it to the column in the middle, you'll see that dividend growers, or companies that initiate their dividends, have over time realized higher annualized returns than companies who don't have any change in their dividend policy. So there is a long-term advantage to buying dividend growth stocks. Now, in terms of Pfizer, the reason why we removed Pfizer was because of lack of growth. The company failed to raise its dividend last year for the first time since 2009. The reason why they gave is that Pfizer's CFO said they want to put more resources towards reigniting the company's growth. The company's been struggling with a pipeline that has not been producing blockbuster drugs. You've seen the profitability get worse. And so the CFO is really halting the dividend. They're not eliminating, they're just halting it, but so he can really allocate more cash to get the company back on a growth cycle. He suggested that we may not see a dividend growth being announced from Pfizer until 2028, 2029, 2030. So that's a long time to wait. So we actually chose to get out of Pfizer and look for a stock that's more attractive now. And this is a good example how disciplined investing isn't about yield alone. You want to look past yield, look at the characteristics that are driving the yield and what characteristics are leading to dividend growth, and ask yourself, are those characteristics still attractive, and is the valuation still attractive? In our case, we saw weakening fundamentals in Pfizer, and we also saw a complete lack of growth and no expectations for dividend growth for the next several years. The final pillar is dividend strength. And we like Merck because it does have the financial strength to continue paying its dividend. Its payout ratio of 42.3%, while high for its sector, and that's why you see the D in there, it's doing a sector comparison on the earnings payout ratio, which is right there in the upper left. While it's high for its sector, it's at the low end of the company's range. And at an absolute level, it's not bad. So what this is telling you is that 42% of the company's earnings are going out as dividends. So that gives the company lots of coverage to pay its dividends, still have earnings to reinvest in the business. Its times interest earned ratio, which is basically how many times over does earnings exceed interest, is at 21.2. That suggests that Merck has a lot of flexibility in terms of making its interest payments, and that its debt's not a concern. And so the reason why we also look at debt is because if a company struggles to pay its debt, the debt holders can force the company to halt its dividends. So you want to make sure the company can cover its debt if you want to continue paying its dividend, and certainly if you want more dividend growth. Now, in terms of determining dividend strength, there's a couple of things we look at. One is obviously the payout ratio. We also look at debt. We also look at dividend sustainability. And that's basically, has the company continue to pay its dividend without cutting its dividends? And the reason why it's a strong consideration is that we want companies to have the ability, again, to grow their dividend. And the weaker a company's fundamentals are, the more likely it is to suspend its dividend. But we also see weakness play out in yields. And so this is a chart I shared late last year on DI. And it looks at our strength grades. And as you can see, as the grades get worse, yields go up. So what's happening is that investors are pricing in higher risk. The higher the yield is, the more risk investors perceive in a company. Now, you might find companies trading at high yields are attractive because investors have mispriced the risk, but you want to, again, do the dig and make sure that there's actually good reason to believe that investors are mispricing the company in terms of how much risk they're assuming versus what the numbers show you. And this is why higher yields are dangerous, because if investors are pricing in a lot of risk, and they're right to, or they see deteriorating trends, that high yield, while it might seem juicy, could really cost you in terms of how much the stock price declines. And that price decline could be far greater than the high yield you're receiving. So the lesson to this is, tread very carefully before you reach too much for yield, and consider current market yields when determining what is a high yield now, because what is a high yield now, it could be very well much lower than what you might assume it is, what you traditionally viewed a high yield as being. Now, there's other characteristics we seek in terms of looking for dividend stocks. And Merck appeared on our DI ideas list because it has these characteristics. Again, we're looking at dividend growth, we're looking at earnings and sales growth, strong operating margins. We do look for qualified dividends. And the reason why we exclude REITs and master limited partnerships, MLPs, is because they do have different financial structures. They require a different type of analysis, but also we want to keep the DI portfolio tax simple. So all DI stocks pay qualified dividends, meaning they qualify for the 0, 15, and 20% reduced dividend rates as long as you meet the holding periods, which is 61 days around the ex-dividend rate. But part of the reason we also avoid MLPs and REITs is because they have different tax structures. So part of the goal with DI is to keep it tax friendly. Now, there's nothing wrong specifically with REITs or MLPs, but again, a different analysis, different tax structure. So let's move on to how the DI portfolio performed in 2025. It rose for the third consecutive year, and since DI was launched in 2012, the DI portfolio has risen, or has realized gains in 11 of the last 14 years. Now, as I noticed earlier in the presentation, high beta, momentum, and growth stocks, companies with those characteristics of high beta, momentum, and growth, meaning mostly tech stocks, they drove the S&P 500's return last year. They also drove the return of the Dow Jones US index, because that is also a market cap weighted index. So even though it covers more stocks than the S&P 500, its returns are still largely driven by your NVIDIAs, your Broadcoms, your Apples, your Googles, etc. And the other reason I point this out is most other factors or characteristics of stocks fell. So we saw some low volatility, we saw dividends, again, we saw value. So if you weren't actually doing that small segment of stocks that are doing really well in the S&P 500, you actually saw much lower returns than the S&P 500 realized. Now, let's talk about what helped drive the DI's results last year. And it's worth noting we had some big winners in the portfolio. The dividend growth stocks can experience very strong gains even during years when non-dividend stocks are favored. And what you see here, these stocks here are examples of how you can actually still find big winners even when it seems like dividend stocks are out of favor, or at least underperforming the headline numbers you see being reported. And as far as the stocks are showing you above, HAI, Huntington Ingalls Industries, they rallied in response to President Trump's calls for greater spending on naval vessels. Huntington makes naval ships. We actually removed it last year because its valuation got too high. And that is my favorite reason to sell, because if a valuation gets too high, it usually means you made money in the stock. So again, we seek to buy stocks with low valuations, and ideally we sell them with high valuations. So I love selling on high valuations, and we did very well in Huntington. Now, we also did well stocks still in the portfolio. You see that with Oshkosh, a vehicle maker. You see it with Amgen, a drug maker, pharmaceutical maker, Medtronic, medical devices, and CME Group, the big exchange, all had strong returns last year. And we're actually expecting a special dividend from CME to be announced somewhere over the next several weeks. They're shifting the announcement of special dividend to the start of the year. I don't know the exact timing of it, but we're keeping our eyes on it. So CME is kind of nice because you get a growing regular dividend and you get a little bonus of a special dividend. Now, we did have some laggards in the DI portfolio as well. One of them was United Health, which we sold. That company last year, as many of you know, had issues, had questions in terms of some of the new clients it picked up. There was questions about it with its nursing home referrals. There's also investigations into it. So a lot of companies' issues, we got out of it because of that. We also have suffered a loss in Skyworks. Skyworks is a chip maker. For many years, it had a large market share in Apple iPhones. This year, Apple announced it was going to actually switch its suppliers for the newer iPhones. That resulted in a big drop in Skyworks share price. And we did sell both United Healthcare and Skyworks. And I talked about both of those a little bit more in this week's commentary. Now, dividend strategies, like all other strategies, are always dependent on market conditions. When you see growth stocks doing very strongly, particularly those that pay dividends or just pay meager dividends, you're going to see dividend growth stocks lag. You're going to see value stocks lag. It's just how the market plays out. But what we've seen over the long term is that investors who stick with dividend growth strategies will realize portfolio income even during times of price underperformance, and they will see their dividend stocks actually start to do well. Over the long term, we have seen dividend growth strategies outperform, but it is a pendulum. And sometimes value is very much in favor, and sometimes growth is very much in favor. If I had the ability to tell you when the pendulum is going to swing and how far, I wouldn't be giving this presentation. And anyone who tells you they can't predict it is really being overconfident in their abilities, because everybody's crystal ball is cracked. So here's our yields by holding. Overall, DI portfolio has a much higher yield than the market. In the portfolio, Eastman Chemical has the highest yield in the portfolio currently at 5.2%. Jack Henry, which provides software to small-sized banks, has the lowest yield at 1.3%. And even at 1.3%, that's still above the market yield. But as you can see here, a lot of our stocks in the portfolio have yields of 2% or higher, and particularly many have yields above 2.5% or higher. Now, here's our portfolio allocation. Now, this excludes today's allocation of Merck. So when you look there at the healthcare, it's gonna be a little bit bigger. But just because we see dividend stocks does not mean we're only looking at healthcare stocks or consumer staples or utilities. You can find dividends and really dividend growth from a wide variety of sectors. So when we add stocks to the DI portfolio, we do consider industry concentration and we do consider sector concentration. And if you're a dividend investor, I would encourage you to look across the universe of stocks instead of looking at specific sectors, because you can find good dividend stocks in many industries. And you see here, we get technology stocks, we got material stocks in here, industrial stocks in here, wide variety. In terms of transactions, the GI portfolio holds 24 dividend-paying stocks. Last year, we removed stocks and we added 5. The difference is because we added Pfizer late last year, and so we didn't add Merck we didn't announce Merck's addition till today. The DI process is that we're announcing new additions on the first Tuesday of every calendar month. We generally will announce deletions on the first Tuesday of every calendar month, unless there's news that comes out mid-month that justifies the deletion. In the case of Pfizer, we couldn't see keeping it in the portfolio in case someone new came to the portfolio. Our current DI subscriber came to the portfolio, was looking for new ideas, and still saw Pfizer in there. We did not want them to think that was still an attractive dividend stock when it was no longer raising its dividend. The other thing we did last year is we also made a reinvestment in EOG resources. So we do have, there is extra cash left over because we do try to, and every time we add a new stock, we try to invest an amount that's equal to the average position of all stocks, meaning if you take the portfolio value, divide it by 24 stocks, that's the average value, and that's our target goal when we reinvest in a portfolio. And I should use quotations here because we are paper trading, but we did make a reinvestment in shale producer EOG resources. Now, here's our portfolio holdings on a DI ideas list. A DI ideas list are stocks that meet the initial criteria for addition to the DI portfolio. They're our first considerations for investors who may want to look beyond the DI portfolio. And what we suggest for people is if you're going to look at the DI idea list first, consider the stocks that are on the DI or that on a DI ideas list. They're also designated as being in a DI portfolio. You can't see it on the screen because I didn't have enough room to show on the slide and have the chart table be readable. But on the right-hand column of the DI ideas list, it tells you which stocks are currently in the portfolio. These four, as of year end, were on the DI ideas list. Were also in the portfolio. So Abbott, EOG, Jack Henry, and Snap-on, they're all in the portfolio, but they also meet our criteria for addition. So if you're looking at the portfolio and you're not wanting to follow the whole portfolio or want a subset, these are stocks to consider looking at first. I should say Merck was also on the DI ideas list too, and that's where we selected it from. So let's move on to 2026. So one of the things when we look at 2026 is that analysts expect another year of earnings growth. Currently, according to LSEG IBES, earnings for the S&P 500 are expected to grow about 15.5% next year. And as you can see here, it's pretty steady relative to October. As year goes on, we'll see this change. I would be very surprised when we get to the end of the year and we have 15.6% growth. But right now, it does show that analysts are expecting strong growth, certainly among tech stocks, a lot of expectations for AI to drive the growth, but materials are also very strong growth in there as well. Now, out of the group, consumer staples has the lowest expected growth at 7.3%, but that's still a pretty good growth rate. The other thing is, when we look at the market, is what to expect now. We just had 3 years of double-digit gains. And I got curious about how often has this happened. So I went back and looked, and I'll be talking about this in an upcoming investor update commentary. But one thing we've noticed is that we've seen streaks of double-digit percentage gains lasting 3 or more consecutive years. We've seen it happen 8 times since 1926. Now, out of those 8 times, large cap stocks fell on the 4th year 5 times out of those 8. But what's interesting is even when they did fall, most times the declines weren't that steep, and we did have a couple times where they actually went longer. So I'll discuss this more in an upcoming investor update. What I can tell you though is don't necessarily expect a decline this year because we've had 3 strong years, but if we do, maybe it won't be so bad. But the market does tend to fall a random walk, and we are seeing that play out here with history in terms of what might happen. So it's interesting, but it doesn't really give you anything to necessarily set your expectations on with certainty about what will happen. Now, what about interest rates? It's going to be an interesting year. Right now, the CME Fed Watch shows traders pricing in 2 to 3 rate cuts this year. Last year, we saw the Fed drop rates from about 4.25% to 3.5%. This chart here is from the CME. It's actually called the CME Fed Watch tool, and it basically looks at the probabilities traders are actually pricing into Fed fund futures. So this is a real money prediction tool. Now, even though this is what traders are expecting, keep in mind there's going to be some changes to the Fed this year. We have Fed Chairman Jerome Powell stepping down as his role as Fed Chairman. He may or may not stay on as Fed Governor. If he wants, he can stay on as Fed Governor, till 2028 and be a voting member of the Federal Open Market Committee. We also have Stephen Moran's terms actually going to actually end at the end of this month. Now, President Trump can either choose someone to replace him, or he can kind of delay it and leave Stephen still on the Federal Open Market Committee. We don't know, but we also know we're going to get a new Fed chair. Lots of speculation about who it's going to be. I know the prediction markets probably have their favorites. I'm not going to go down that path or see what happens next, but it could be an interesting year for the Fed, possibly one where you do see some people dissenting within the Federal Open Market Committee about what the appropriate action on monetary policy is going to be. Keep your eyes open. We'll see what happens. And obviously, how inflation, the economy plays out will also have an impact too. Now, what about value strategies? Well, value remains historically cheap to growth. At the end of 2025, the PE for value stocks was about 40% lower than it was for large cap stocks. This is below average. So we do expect this pendulum to swing back in terms of favor of value. And when it does swing, it should give value stocks, including a lot of dividend stocks, because most of your dividend stocks tend to be more value-oriented stocks. It should give dividend stocks a nice boost, a nice tailwind. But as always, the timing of when this swing back in favor of value, back in favor of dividends will occur is always uncertain. This is why it's a long-term strategy. You're not trying to time the market. You're getting paid for your patience with the dividends, but then you'll eventually get rewarded too when you see value come back in favor, you see dividends come back and forward. You'll get added to the growing source of income with stronger capital appreciation. So some considerations to turn the market for this year. One of the things is because of the government shutdown last year, we lost some economic data, some valuable government support. So we muddy the information. We do not necessarily have a great read on there. Plus, we also had the immigration crackdown. That's affecting the growth of non-farm payrolls because fewer people are getting jobs because we had a reduction in jobs due to the loss of the migrants that were occupying those jobs. So it's muddied the numbers when you look at the employment term numbers. Again, the new FOMC had the new chair of the Federal Open Market Committee could find himself or herself between political pressure to cut rates and more hawkish members of the committee. There could be concerns about spending of AI and whether or not that leads to some correction in the S&P 500, particularly if there's a sense that the companies that are borrowing all the money to build the data centers, whether they start having troubles, that could be an issue. And we'll see how that plays out. And then obviously we just had this weekend's events with Venezuela. It's unclear how much oil Venezuela can sell right now because my understanding is their oil service sector is a mess and needs a lot of work. Also, the type of oil they sell tends to do better at higher prices than lower prices. And obviously, capture Maduro creates some regional and global geopolitical uncertainties. So Venezuela is a wild card. Too early to make any prediction about that. So now I want to show you some key features about dividend investing. Again, as I mentioned before, it's a 24 stock portfolio, and we seek out stocks with dividend growth that are trading at attractive valuations. Now our DI ideas list, I mentioned this before, here's a slightly longer list. This shows stocks that meet the DI's initial criteria for yield, growth, and profitability. It's where we go to find new candidates for the DI portfolio. And so if you're seeking stocks in your own portfolio, you could, let me go back here. You could either start with the DI portfolio, which is stocks we look at and we're following, or you could go to the DI ideas list, or you could do both. You could use a combination of the two. Our suggestion is to follow the DI portfolio if you want to track the returns we get, but if you'd rather use it as an ideas generator, you do have the DI portfolio list where you can actually look over our shoulder and see what we're following and the decisions we're making. Or alternatively, you can go to the DI ideas list as well. We also have a dividend investing screener in here. And this allows you to screen stocks based on valuation, dividend growth, or dividend strength, or just one of the three. You can also use this to screen the entire universe of dividend paying stocks, or if you have your own portfolio and you're a DI subscriber, you can actually screen your own portfolio. For instance, what you see here is I actually took the DI ideas list, I saved it to our My Portfolio tracking tool, and then I actually ran a DI screener saying, give me stocks with dividend growth grades of A or B, dividend value, dividend strength scores of A or B, and give me a dividend valuation of A, B, or C. As you can see here, Merck was the third stock to actually appear in the list. And that's part of the reason why we picked Merck, was I actually took the ideas list actually and ran the screener on it. Now the two before it, AAII Corporation, I passed on it because it's got an inconsistent special dividend. Also, it's not been consistent in terms of its overall earnings growth. EOG Resources, it's on a DI ideas list, but we actually own it in the portfolio itself. So obviously Merck was the next stock, and I took a look at it, did background check and make sure there wasn't anything in the numbers that would give us reason for pause, and that's how we selected it. But it's a helpful tool if you are a dividend investing subscriber to use my portfolio, and then again, use the dividend screener to get a better insights to your own dividend investing stocks. We also have the dividend grader. This gives you more detail on all the stocks. We actually show you the history and the grades. We have the financials on here. We also give you a lot of detail on this on each grade. What components, say shareholder yield and relative dividend valuation, which I showed you earlier from Merck, you can find it on this page, and you can actually look at any dividend paying stock on DI and get the dividend grades and get a detail on what's behind each grade, what factors are actually influencing the grades for that stock. Now, the other thing I want to show you, if you're a DI subscriber, or if you're a subscriber to one of our other premium newsletters, you can get views in our new My Portfolio. So our My Portfolio is our portfolio tracking tool, a very popular tool. We just rebuilt it from the ground up in our AAII Investor Hub. And that My Portfolio is available to all AI members. But if you subscribe to DI, what you can do is you can get a view, and you see that drop-down menu on the left-hand slide, on the left-hand side. Click on DI, and what you see here is you can actually analyze the stock by the same criteria we use to analyze the DI portfolio. You get the grades for all your stocks. And as you can see, it's drop-down screen. If you're a platinum subscriber and you have access to SSR, you have access to growth, you can actually select those views as well. So that's all our new Investor Hub. And if you haven't been to it, I really encourage you to visit the hub. It's actually linked on the tools section of our website. And I strongly encourage you to visit it. We got a lot of great tools on here. Now, Jenna, I've been speaking a lot, but I know you have a great review week offer to share with members.
Yes, definitely. First off, we want to really just thank everyone for attending today's event. We have events scheduled every day at 1 p.m. This week. So we've got 3 more to go. 2 down, 3 to go. And if you would like to attend one of the other events that we have, tomorrow is AAII Growth Investing, Thursday is DMQ Stocks, and Friday to close out the week is Stock Superstars Report. Those are all free to attend. Anybody can join. But if you're interested in actually subscribing or becoming a subscriber, we're offering all of our webinar attendees just this week only, valid till January 12th at midnight Central Time, an extra $50 off a new 1-year premium product subscription, including AAII Platinum, when you use the promo code WebinarWeek50 at checkout. And that promo code will expire on January 12th at midnight Central Time. And you can just visit AAII.com/webinar-week to claim your offer. And you can get some more information also about the different products that we offer. We have a lot of good information on that page as well. So if you want to peruse and just kind of see what we offer, the other model portfolios, or if you're interested in upgrading to platinum, this is a good opportunity to do it. Get an extra $50 just for attending our webinar this week. So we really appreciate, again, they're all free to attend. So if you would like to just attend a webinar to get some more information, that's perfectly fine. We've got 3 more events, so we hope to see you at least one more this week. All right, let's see. Charles, are we ready to go into the Q&A time?
Yes, but only the easy
Excellent.
ones.
Only the, okay, I'll pick out. We actually have a lot of great questions. Everybody's
Good.
been very attentive and sending in a lot of very good questions, so I appreciate that. Let's
Yes.
see. Well, actually, you know what? First off, I do want to ask you, because I forget, I always ask this just right off the bat at every model portfolio review, is what was the biggest surprise that you saw this year in the DI portfolio or among dividend stocks more broadly?
Biggest surprise. I think honestly, I think one less people should pay attention to is that there can be issues that go on with companies that aren't always jump out at you right when you look at the numbers, or sometimes you can see trends in the numbers that call your attention to problems. With United Healthcare, a lot of their problems actually were not what you're not necessarily seeing in the financials. It was a really events going on with the company, and that's why it makes sense that even if you're a long-term investor, to just pay attention to the news. You don't have to look every day or every week, but just keep an eye on the headlines of what's going on. And in case you're not in healthcare, obviously that made big headlines because particularly you're dealing with scandals involving Medicare. That's a pretty big thing. But with Pfizer, we were watching it, and I had noted before that we were curious to see whether or not Pfizer was going to sustain its dividend growth. So I think as an investor, you can pick up clues to whether there's positive or negative investments to the company. If you do look beyond the headlines, look at the financials, try and look for the trends that are kind of jumping out at you and see what's going on. And again, sometimes you might pick up very positive trends, but it is that part of being an investor, knowing to do the quantitative outlook, but not ignoring the qualitative outlook as well. And it's about using your own analysis instead of necessarily relying on what you might see on CNBC or say in the Wall Street Journal, or certainly these days on social media.
Yeah, no, that's very good advice. Let's see. So we talked a lot about at the end about the DI ideas list and everything. So for someone who is just become a subscriber or is thinking about becoming a subscriber to DI, how do you suggest investors use the ideas list? Is it something that they should use as more of a watch list, something that they should just get more ideas from? What is your suggestion?
Oh, that's a great question. So in our user's guide, we do suggest people start with the portfolio itself. And you want to look particularly at the stocks that are actually listed as being on the DI's list. And they're basically stocks with grades of A or B. But if you see a stock with A or B grades for strength and dividend growth, but has a C for valuation, that can still be attractive stock. It might just mean that when we look at the relative valuations, its relative valuations may not quite be as attractive, but you do want to make sure that it's still below its 5-year average yield. But then the DI ideas list is really just an additional list for additional ideas. So, and particularly if you want to favor industries that we may not necessarily be in or have enough exposure to, or if you do prefer, I really want really strong growth, I really want a high yield, you can use it as an additional list. I would treat it as an additional option for it. I would just start with the DI ideas list, but I do want to say though, as a subscriber, it's your portfolio, so it's ultimately your decision which you feel more comfortable with. Just realize a lot of stocks on the DI ideas list, it's a quantitative screen, and we have not looked at every stock on that list. Every stock goes on a DI ideas list. We have kicked the tires on. We are paying attention to. So that's one thing you do get with with the actual portfolio that you don't get with the ideas list. But any stock I'll add to the DI portfolio will come from the ideas list.
That makes sense. And we send portfolio alerts. You're mentioning that we're transitioning to sending portfolio alerts on the first Tuesday of every month now. So how should investors treat those alerts? Should they treat them as an indicator to sell or buy immediately, or should they wait and monitor, or just kind of keep it on their kind of their watch list or their monitoring status? Like how should they treat those emails that they get?
That's a great question. It applies to all our portfolios. The general rule we tell everybody, regardless if we're talking DI, we're talking shadow, we're talking growth, SSR, VMQ, is you don't have to buy right when the alert's sent out. Sometimes you can actually be cheered, depending on the portfolio, particularly shadow. I know John talked about this yesterday. It could be to your advantage to actually wait a couple of days and let the price settle. What we generally tell people in our user's guide is try to buy within the first week, and try to see how the stock's going. Is the stock, moving in your direction, meaning it's falling in terms of purchasing it, or is it rising? If you're interested in the stock, you may want to consider buying that week because the stock will still exhibit the characteristics we are seeing. But consider yourself, consider what's best for your portfolio. The one thing I would suggest, though, regardless if you buy it right away or if you wait, I always use limit orders. Even if the stock is a big company, it tends to trade a pretty narrow price range. I always use a limit order, basically saying don't pay above this price or don't sell below this price, just because sometimes wacky things happen in the market, and it ensures that you're not getting basically a bad execution, whether you place your order and suddenly the stock jumps 15, 20 cents or whatever it jumps. You're telling the broker, I'm willing to accept it. And depending on the stock, you might have to wait a little while for that trade to be executed. And there's always a danger that you might have to go back and adjust it, but it's just a layer of protection. So even if you're buying a big stock like Merck, I still think it's just a little safer to use those limit orders. And I myself, for an ETF or a stock, I never buy one or sell one without using a limit order personally.
I agree, I do too. And so we have our AAI stock grades, and then we have our DI grades and the DI pillars that you went through. How should an investor use those? Should they be used complementary, or kind of, if you're looking at dividend stocks, you should only look at DI grades? How do you, or how does AAII want investors to kind of use those two different sets of grades?
Sure, so there were actually separate grades, just they're complementary to each other. The DI grades specifically deal with just dividends. So even when you look at the DI value grade, we have an A+ value grade. They're very different. The AI value grade looks at 6 different valuation measures, whereas the DI grade is actually looking specifically at yield. And it looks at the dividend yield and the shareholder yield. So while the A+ value grade does have a shareholder yield component in it, it's also considering things like price of sales, price to book, price to earnings. And so it's actually looking at more price to cash flow. So it's looking at different measures than the DI value grade. The DI strength and the DI growth grade are actually looking at factors specifically tied to dividends, whereas the A+ growth grade is really looking at earnings and sales growth. The quality grade's looking at a broader range of quality indicators, so they're complementary. You could combine them. I think the one thing I would caution you is don't necessarily try to find a perfect stock. Really, the goal of investing is to find attractive stocks trading at an attractive price, not the perfect stocks. Now, occasionally you'll find a stock that's perfect on all the grades, trading at an attractive price. But the analogy I like to use is okay to buy a car with dents, dings, and rust spots if it's trading at the right price. And that's the same thing for investing. And it doesn't matter if you're following a dividend strategy, a growth strategy, or something else. The key is to find a stock that's attractive at the price it's trading at.
That's a good analogy. And I think you talked briefly about if a stock becomes or goes on to probation, you're trying to evaluate whether or not you're going to keep it on the DI portfolio. How long will a stock typically stay in that limbo period before being held or sold? And then also, is there a specific place where investors can see that information, whether a stock is on probation or not?
So I will note it in the commentary if I'm watching a stock that's looking like it's at risk of getting sold. Sometimes we can see it coming down the pike, and sometimes I'll say on there, look, we're looking for this company to, in case of Pfizer, I'll say, we're looking to see what Pfizer's going to do with its dividend increase and whether they raise it or not. So I will talk about the commentary, what we're looking for, what we're watching for. I try to, if I see a stock approaching its valuation levels, high valuation levels, I'll say the stock is getting, particularly the monthly commentary, in the monthly wrap up, hey, we're watching the stock, it's getting towards the high end of its valuation range. We're watching it. So I try to give people notice about what's going on with it. Occasionally there will just be surprises that come out of nowhere. But we usually can at least start seeing the warning signs and know what to watch to keep an eye out for. And so I will talk about it in the commentary, particularly again in that monthly commentary. But I might also, every week I try to, point out things in there. So try to usually give a long leeway.
Yeah.
But again, sometimes things just pop up and we have to sometimes react quickly when it does.
It's true. And we've got a lot of good questions. I do want to reiterate, because I said it at the very beginning, but if we don't get to your question and you would like an answer, please email us at members@aaii.com so we can get to your question. We're going to do one more before we kind of start wrapping up. I have a lot of good information to share with everyone about what to expect for the rest of the week. So I want to make sure we have time for that. Let's see. Okay, so we have actually a lot of people who have mentioned, they are active or avid, DI model portfolio subscribers. They hold a lot of, actually quite a few stocks, but they are also looking at ETF and mutual funds. So what kinds of resources does AAII offer for those who are looking at dividend growth, kind of focused ETFs or funds? And then where could they find those on our website?
Sure, we've written a little bit about dividend ETFs actually on our website. We can link those articles. The other thing is, if you go to our mutual fund ETF guide, Morningstar does not have a dividend category. But if you click on value for either large cap, mid cap, or small cap, you can do that, then look at the dividends, the funds with higher yields, or just screen through those funds, those mutual funds or ETFs, and look for the name dividend in them. Those will be where your dividend funds are. And once you're in the guide, you can actually select one or more funds, either mutual funds or ETFs, and then you can actually, if you click on more than one, there's a little checkbox on the left-hand side. If you click on two or more, it'll give you the option to view those in either a mutual fund or the ETF evaluator. And that evaluator tool, which is available to all AAII members, allows you to do side-by-side comparisons of ETFs or mutual funds. Now, the nice thing about that is if you type on yourself, you can actually do mutual fund ETF comparisons as well, which is kind of neat with that comparison tool. And if you want to track those, you can also add them automatically to your portfolio as well, but you will find them listed under the value category because that's how Morningstar categorizes them.
Excellent, excellent. Well, first off, thank you so much, Charles. I really appreciate your time, guiding us through the dividend investing portfolio, looking at, some of the top performers, and then also, some of the more, dive into the strategy, also the resources that, we offer dividend investing and platinum subscribers. But I did want to offer you, some time if you want to last kind of anything that you want to share with our members before I kind of go into the last part of our webinar event.
Yeah, I'd just say one thing. When you look at this weekend's events with the news headlines, and you look at all the news headlines we had last year, and you look how the market's doing today, it's up nicely. I think it goes to show the importance of being a long-term investor because there's so many known unknowns and so many unknowns. I don't think we go back a year from now, or certainly go back 2 years, where we're going to be talking about Maduro being in a federal court in New York. I think it's really important to realize that as much as people try to get predictions about their future with confidence, there's always unexpected things, there's always uncertainty that's going to happen. But if you have a good investing strategy that you can stick with over time, and that strategy is evidence-based, over time you will be rewarded for your patience and for your discipline.
Excellent, excellent. Couldn't agree more. And if you have any questions, because we covered a lot of great information today, but if you do have questions about the DI portfolio, its performance, holdings, etc., or if you have just general membership questions, please feel free to email us at members@aaii.com, or you can always give us a call at 312 888-676-4307, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then just to kind of reiterate and make it clear, the AAII Dividend Investing portfolio is a premium subscription, but it is also part of our AAII Platinum service, which is our bundled service. And like I mentioned earlier, all webinar attendees can get $50 off a 1-year premium product subscription when they use the promo code WebinarWeek50 at checkout. I did put that in the chat earlier a few times. So you can visit AAII.com/webinar-week to claim this exclusive offer. And then just remember that the offer is valid through January 12th at midnight Central Time. And then if you'd like to attend any of the other webinar events this week, please visit AAII.com/webinars to register. The next event that we'll hold will be AAII Growth Investing tomorrow, January 7th at 1 p.m. Central Time. And both John Bykowski and Cynthia McLaughlin will be presenting. And then lastly, this presentation was recorded and a replay will be available at AAII.com/webinars. And webinar attendees will receive an email with the link to the recording and then early next week. You'll also receive a copy of Charles's presentation slides as well as any links to other resources that we find helpful or that we discussed today. And then remember, we have events all week long and they are free to attend. So please join us at one or more scheduled this week. The schedule is as follows. January 7th, tomorrow is AAII Growth Investing. Thursday, January 8th is VMQ Stocks. And Friday, January 9th is Stock Super Service Report. And then all events begin at 1 p.m. Central Time and go for just a little over an hour, depending on the length of presentation and a Q&A. And we hope you join us for another event this week. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much and take care.
Happy New Year.
Happy New Year.